Hey, what's up? It's episode 110, Pain Points of Wealth, and the economic data continues to come in strong. GDP growth, economic growth for the fourth quarter was better than expected. We're seeing earnings growth relatively strong for the fourth quarter and guidance not falling off a cliff. So what we're saying here is the data is coming in much better than has been anticipated on Wall Street, and the market is following suit. We're in a bull market. Prices are going higher. But is this a fake out? Do you need to get to the sidelines right now? Is the economy ready to fall off a cliff, or is this the real deal? Well, we're going to give you our 2 cents today. We're going to tell you exactly what to do. And on the tipping point today, we're going to talk about lessons you can learn from last year. It was a volatile year, a lot of uncertainty. We're going to make sure that you learn those lessons to make sure you're financially on your path to freedom. Check it out. We got a fantastic show for you.
Well, you know, guys, the conventional wisdom over the last year was the Federal Reserve is going to have to get so aggressive, they were going to have to kneecap the economy and bring it down. Where it turns out, that was more just like excessive pessimism. And, I was watching an episode of Seinfeld the other day, and George Costanza, the biggest loser in the universe, decided that every decision in his life he made, and it was wrong, right? He decided, I'm going to do the opposite now. I'm going to become the contrarian Costanza. So the George Costanza strategy is do the opposite of what he thinks he should do or what the experts are telling him to do. I'll tell you what, it worked out pretty well following that strategy over the last couple of months.
Well, you know what, guys? I could remember growing up, Ryan was a lot like that. He called him the old man because he never liked change. He never wanted to do what everybody else wanted to do. He always did the opposite. I think we should start a fund, just call it Ryan, R-Y-A-N. And you know what, Ryan? This is your opportunity to move back home with mom and dad.
I was going to say, I'm not above it. I would love to live with mom and dad again. Laundry done, home cooked meals, sign me up. But no, I think that is actually the Payne view. It is always a bit contrarian. And I think last year is a perfect example, right? We had every strategist, every economist still actually extremely negative on the economy, extremely negative on the market. And like if you're diversified last year, you were down around 10%. It's not that big a deal. And meanwhile, now markets are off to the races. And if you were sitting in cash or you tried to time it, you've kind of put yourself in a bad position now.
Well, it's almost as if you're optimistic and you're pro risk assets. These talking heads on the news media, they get mad at you. Like, what do you mean? What do you mean it's good? I mean, how could the emerging markets have gone up 30-40% since October? How's that possible? It must be rigged. There's something wrong. How about this is how markets operate, right? Markets operate by discounting the future or discounting the current environment and looking to the future, guys.
Well, it's funny. I was talking to a client of mine the other day, Dad, and he was fretting about how the performance of the portfolio did last year. And I said, well, you were down less than half what the market was. You did great. And then he started going on a rant about how he doesn't like international and emerging markets. And I said, well, you're living in the past, man. I'm like, you haven't looked at your account this month because emerging markets is leading everything. And he's like, no way.
Well, Bob sent this stat out, which is crazy, that Germany, right? And Germany was the poster child of the worst place to be last year, right? They had this energy crisis. They're getting hit the hardest because Russia invaded Ukraine. Russia kind of has them by the ganoogies when it comes to energy. Yet Germany is up 40% since September. How can that possibly be? And it's kind of like the darkest hour is right before the dawn. I said, bull markets are born under a bad sign. I mean, it's like when things are terrible, that's the best time to invest. And it's so counterintuitive.
I can't find the word ganoogies in my dictionary, right?
I'm trying to keep it very clean on this podcast, Chris, please.
Well, as I always say, guys, you don't get good prices, with good news. So you have to be able, to have the fortitude to invest when things are down. When the optimism is not there, it's better to be more pessimistic. But just think about it. Most of us are average, normal human beings. We project the future based on our most recent experience. And as the year went by, the news got more dour, the market got more volatile. So what's human nature tend to do? Get more pessimistic as the pessimism appears to be greater. But the greater the pessimism, the greater the opportunity, as it turns out.
Yeah, and it's Bob, you had a really good line. I think you obviously stole it from somebody. It couldn't have been your own line. Is anticipation is mitigation. And, you talk about all these company CEOs, like last year, they were worried about a slowdown, just like you and I were worried about a slowdown. So what do? They get proactive very, very quickly. They start to rewrite their business for these anticipation of things slowing down. So they're already fixing the ship, right? Before the slowdown actually happens. So all this proactive activity is happening to make sure that, companies' balance sheets stay in check. And that's why you always see the surprises in the positive, because that anticipation is already happening. As we're worrying about things, people are actually taking action. Company CFOs, CEOs are going into their businesses and fixing them.
Yeah, you're absolutely right, Rye. Anticipation is mitigation because, as the talking heads are telling us that the economy is slowing, everybody can clearly see that. They're starting to reduce their earnings estimates. So when the estimates, are then met with the actual earnings, the market's like, well, I'm not surprised by that. That's what we expected. It's actually better than expected. So what happens is that, as these bad news comes through, it loses its surprise power. And that's what the market reacts to, right? The market reacts to black swan events. They're the things you got to worry about. And the problem with a black swan event is you have no idea what it's going to be.
It sounds like maybe timing the market's not such a good idea, is what I'm hearing.
It's not at all, Chris, because the market's always climbing this wall of worry, and there's always a new brick that they put into the wall. But we know what that brick is. It's the brick you don't recognize, you don't know about, so one's going to get thrown through your windshield.
The other thing I noticed, too, in talking to some of our clients is that these bear markets seem to last longer in mine than they actually do. I had a client I was talking to the other day, and they said, we haven't made any money the last 3 years. We've been in this bear market. And we went through performance line by line. He said, really, the market's only been down for a year? I said, yeah. He's like, well, it seems so much longer than that.
It does, and it's an illusion, right? And the other thing is, when you look at it, like last year, the conventional wisdom was like, you know what? Let's just get out of the market while it's volatile and let's lock into a 4% CD. Well, you locked into a 4% CD, well, the market's up 6% now. And you have to wait a whole 12 months to get that 4%. And you've missed that move in the market now. So it's amazing how quickly times can change and markets can change. Meanwhile, emerging markets up 10% as we're recording this. You don't get that return back. And if you locked your money into a CD, you kind of put yourself behind the 8 ball because you missed the recovery and you have to wait a whole 12 months to get that return. It's crazy.
Well, here's another sailing analogy. Your boat's not going to go anywhere unless your sales are up. You're not going to make any money unless you're invested in the market.
Well, as you guys have mentioned the other day, it's like $5 trillion sitting in money market funds, right? Yes, hey, it's getting 4%. Isn't that wonderful? But what happens when you don't get 4%? And by the way, that 4% is over a 12-month period. You've already missed the 1-month period where you'd have a 50% better return. But, as one of the strategists that used to work at the firm I worked at, great guys, long gone, he put out a piece one time and he was showing this surfer standing on the beach looking at the beautiful break at the Bonsai pipeline with his surfboard. And the headline was, hey, you can't catch the wave unless you get in the water, right? So, you can sit there and talk about all day long how negative things are and sit in cash, but you're not going to make any money if you're sitting on the beach.
Well, to go back to Chris's sailing analogy, if we have to do it, it's at some point the wind's going to blow, but the sail's already going to be in the air. And I think that's a great point. Think of all the FOMO with that $5 trillion sitting in cash, while you're starting to see markets catch a fire here, to use another analogy, another metaphor. And also, we were talking to a client who was talking about how much money is just sitting on the sideline to do deals. All these private equity firms sitting with all this cash in these big banks that have to put the money to work, or it goes back to their investors, and they want to put it to work.
Well, I mean, look what Chevron just did. They just raised their dividend. They announced a $75 billion buyback. $75 billion buyback. Exxon came out with a similar buyback. So there is a lot of cash on the sidelines. And, the question is, where's that money going to go in the future? And the pressure, from professional money managers, from institutions, from hedge funds, and from individuals, it's just going to continue to mount. The market will make you do the wrong thing at the wrong time.
Hey, hope you're enjoying episode 110, Pain Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach, and you want to make sure that you're on your track for your path to financial independence, Bob, Chris, and I now have a collective 75 years helping individuals just like you with your planning and investing. And if you qualify, if you saved over $1 million, we'll put together a full total financial master plan, and we'll do that with no obligation or cost. There's no other firm out there that will literally do this work up front. We're going to look at Income. If you're getting close to retirement, we're going to put together a full income plan, show you how to take Social Security, how to draw from your portfolio so you don't run out of money, factoring in inflation. We're going to look at diversification. How's your portfolio holding up? Did you get hit hard last year as markets were extremely volatile? Or have you been sitting in cash earning nothing as inflation is still at a 40-year high? We're going to put together a full investment game plan, show you how to grow your money, but most importantly, protect it over the rest of your life. And we're going to look at fees and taxes. Wall Street loves to sell you portfolios that have lots of fees that are hidden in your portfolio. And those annuities, insurance products, brokerage products, we'll show you how to reduce all the costs on your portfolio and optimize your portfolio for taxes, giving you our full tax playbook. It's not what you make, it's what you take. Then we're going to pull it all together into one total financial master plan. All you need to do is go to www.paincm.com/financial plan to see if you qualify for a free financial review. All right, it's the tipping point. This is where we pinpoint the pain point. Of course, that's PAYNE, having the biggest impact on your wealth right now. And Bob and Chris, being prepared financially is more critical than ever, especially given all the volatility and the uncertainty we've experienced in the last really 12 months or so. So I thought we could discuss some of the lessons that we've learned from 2022 that can help guide all of us to make better financial decisions in 2023. And I think the biggest theme of last year was inflation is actually real, and you've got to account for that in your financial plan.
Well, you know what, Ryan? I was talking to a client of mine the other day. He's 40 years old. We were going through their projections. They spend like $100,000 a year. And he called me back a few days later after he looked at the projection. He said, Chris, I think you really messed up our expenditures. It says at 80 years old, I'm going to be spending $400,000 a year. He's like, we only spend $100,000. And I explained to him about inflation. He said, man, I think we need to save a lot more.
It's good advice, Chris, because, inflation is hitting, it's insidious, it's hidden, but it's real. And, of course, it's been in the headlines for the last year because, especially the way the Federal Reserve has completely dropped the ball and not recognizing that inflation wasn't transitory initially, and now not recognizing that maybe it is. So we're dealing with higher inflation than we've had to deal with in 40 years. But over this 40-year period, you still had inflation at 2%. And even at 2%, that still means a huge cost of living increase, over your lifetime.
Yeah, and I think a good rule of thumb we always use is something like you're going to have to double what you need to live on every 20 years. And most of us, you're going to be retired for maybe even closer to 30 years plus. So you really have to account for your expenses doubling in retirement. And most of us don't do those calculations. And we always talk about this, but it's dangerous when you have an income portfolio that doesn't adjust with inflation. And this is where I have a big qualm with a lot of the annuities that are sold, not bought, of course, is you get the same income coming in every single year, yet your cost of living is going a lot higher. And this can be a big problem for your financial plan.
Yeah, it's kind of like we always talk about compounding, how important it is for your portfolio. But in the case of inflation, if you're keeping too much money in cash, compounding works against you.
Yeah, I'll tell you what, though, Chris, it's lovely to have that compounding working for you. I recommend everybody take a look at that Madoff series that's on Netflix. You learn a little bit more. It's it's rehashing a lot of the details and pulling that scab off from, what that horrible man did to people, back in 2000 and 2008. But, the thing to recognize is that in 2008, the Dow was trading at 8,000, and here we are at 34,000, showing you that's the magic of compounding. And, I spoke to a client the other day, and they said, how's that possible, Bob? Everything's been so awful the last 15 years. Well, guess what? It hasn't been awful. It's been pretty darn good.
Well, Bob, you gave us a really good statistic last week. I didn't even realize this, but dividends on the S&P 500 increased by 10% last year. Meanwhile, the full year inflation was only 6%. So point is, having income in your portfolio that readjusts over time is so critical. And I'd argue most of us don't have that in our financial plan.
Well, guys, it's not just about it is about planning and planning for inflation. But here's the other thing. I spoke to a new client that we just onboarded, and they said, well, in all fairness, it was easy for you guys to make money for clients over the last 15 years. I'm like, easy? Are you kidding me? We came off the two worst bear markets, right? I think, Rye, you or Chris talked about this a couple of weeks ago, right? We had 2000. The market went down 60% on the S&P. Then 7 years later, you have a repeat. Boy, I'll tell you what, when we started paying capital in 2008, it was like pulling teeth getting people to invest when we had markets selling at generational lows. I mean, the greatest valuations in history. I'll tell you, from 2008 to 2014, all people wanted to do, all investors wanted to do was sell because they wanted to get out before the next big bear market.
Yeah, no, it's really true. Investing is really hard. And I think the other lesson we learned from last year is you probably didn't know how much risk you had in your portfolio. You know, a lot of the new clients that we brought on in the last year or so, the biggest issue was they didn't realize that they were overweighted to technology. They were overweighted to a lot of these disruptive mega cap growth stocks, over-concentrated. And then when the shoe dropped, and a lot of times we saw portfolios down 30% last year, 40% last year. But the problem is you only realized it last year when the market was going down. And it's just so critical to manage that risk because, as you always say, Bob, risk is only seen in hindsight.
Yeah, it's certainly recognized in hindsight, Ryan. And one of the things you can't have foresight for is what we talked about earlier, black swan events. You're going to have unexpected market sell-offs, right? What did I always tell you guys? Why are there unexpected moves in the market?
Because they're unexpected.
Exactly. Everything else is priced in. So, look what happened in 2020 when we had the pandemic collapse, right? 35% in 2 days. Back when you guys were young pups, I was sitting in Hawaii on a vacation, as it turned out. But the market in 87 went down 2 days, 35% in 2 days.
Yeah.
Now just think about what's 35% decline of a 4,000 Dow. I mean, you know what that will do to you mentally? You pick up the paper, you turn on the TV, and you see the market down 35%. You've got to be prepared.
Yeah. More importantly, does that could actually take you out of retirement? And Dad, I remember you talking about this during the tech bubble right before it burst. And when it burst, you saw a lot of people go back to work. Like, I remember we had someone who was working with you when you were at Merrill Lynch back in the day that put all their money in tech stocks, disregarded your advice, and literally in their 70s had to go back to work. That stuff's real. Market risk is real. And it's one of those, I think we're starting to realize that, oh my God, I've got to be really, really cognizant of the risk I have in my portfolio, especially if I'm going to live off my money. You've got to be so careful. And a lot of us aren't getting the right advice around that.
Well, it just goes to show you that ignorance isn't bliss. Hope is not a tactic. And, you really should have your portfolio thoroughly evaluated to make sure that you're covering all your asset classes and not just invested in one thing, because as the old saying goes, you live by the sword, you die by the sword.
Well, how about prayer, Chris? Does prayer work?
I think that goes as hope is a tactic.
Okay.
Yeah.
All right. Just check.
But you should pray for us anyway.
Bob, you're beyond that kind of hope. Bob's trying to get to heaven before they close the doors, but I don't know. I think those doors were closed a long time ago.
I don't know about that, but I think it's again, you've got to recognize that you don't know. You have to know what you don't know, and that the future is unknowable. And all these talking heads keep telling you they know what's going to happen. They don't. So diversify the living daylights out of your portfolios, guys. That's our advice.
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, while the S&P 500 price declined by 19.78% in 2022, S&P dividends went up by 10.82% in 2022. The increase was higher than inflation, and since 1926, dividends have contributed approximately 32% of the total return of the S&P 500, while capital appreciation contributed to 68% all the way through 2021. Bottom line is cash flow is a huge component to your return in the stock market.
Hey, Ryan, you're absolutely right. Almost 40% of your return comes from the dividends. But more important, it's not spending those dividends. It's reinvesting those dividends into more shares, which, ends up with the compounding, the miracle of compounding, which we call the eighth wonder of the world. But, the key is you've got to stay invested in order for that to occur. Now, here's the one thing you got to remember. This all works as long as the world doesn't end. Last I checked, guys, world doesn't end very often.
If that's your only risk, you've got other problems, right? But I think that is remarkable, going back to last segment. Even with the market down last year, well, cash flow in your portfolio actually went up if you stayed invested. And that's the point, right? If your cash flow is increasing as cost of living goes up, that's how you win the game of financial independence, and most of us don't look at it that way. It's such a common sense concept, but most of us don't focus in on that. It's all about the market's up, the market's down, but that's not the critical part. It's the cash flow.
You're
Chris,
telling me, Rye, is more is better than less?
keep it simple here, Bob.
I always felt that way about my hair.
Well, Lord knows you've got more than less, Bob. So you've certainly been blessed with wonderful hair. Chris, Canada labor shortages are so severe that the government has announced plans to admit nearly 1.4 million immigrants over the next 3 years. I think that's the big problem everywhere is we just have a lack of workers. Same problem here in the U.S.
There's still restaurants here in Philadelphia that are only open 3 days a week just because they can't get people. I mean, I've got clients that own businesses. It's the same issue. It's just the problem is the same across the board. People just don't want to do these jobs. So, whatever it takes to get the economy back up and running, getting those restaurants open, getting those jobs done. I think Canada's got the right idea.
Yeah. I think at some point we're going to have to come up with a more formalized, bipartisan, if that's possible, immigration policy because we just don't have enough people to fill jobs, which means unemployment is probably going to stay low for a very long time. Bob, Ken Griffin's Citadel hedge fund cranked out a record $16 billion in profit for clients last year, topping John Paulson's bet against the subprime mortgages in 2007 that was described as the greatest trade ever. The top 20 hedge funds collectively generated $22.4 billion in profit after fees. Man, oh man, Ken Griffin pretty much gave all the return for all hedge funds. That guy's amazing.
My, oh my, $16 billion. Why can't we get this guy to manage our money, guys? One hedge fund makes all that money. What happened to all the other hedge fund managers? They lost $125 billion combined in 2022. $125 billion in losses. I'm telling you what, these hedge fund guys, they take way more risk. They generally don't make money. Hey, God bless Citadel. They had a good year. Hope they can continue it. My guess is probably won't.
Well, we have a cousin that works there, so we'll have to get his inside track on it next time. But it is remarkable given the fact that hedge funds in general have had horrible performance for the last decade or so. But some managers out there just have that special knack. But hey,
yeah, I wonder if it's special access, Rye. I think there's some questions have to be asked there. It seems, okay. When it seems too good to be true, what do I always say?
It might be. Well, hey, another great podcast. Hope you enjoyed episode 110, Pain Points of Wealth. If you love our podcast, you like our podcast, you find it kind of intriguing, give us that 5-star rating on iTunes. Leave us some comments, please. Go to bebullish.com/questions for any questions you want to ask us. If this is on Spotify, you can like it, subscribe to our podcast. And if this is on YouTube, give us a like on this episode. You can subscribe to our channel and click that notification bell to be updated every week of all our new content. It's your enthusiasm and support that give us the ability to keep doing this podcast. That's it for this week. Stay loose and keep an open mind.